All right. Hello, everybody from across Canada. Good afternoon or good morning, because we got literally across Canada today. I want to thank you guys so much for tuning in. It's Mike Vrobel, manager for Royal LePage Learning Services, and I'm here with Kiki in the room with me.
Good morning, good afternoon.
And I just want to go through a couple slides, just do a little bit of housekeeping for everybody. A couple important slides for you guys to see. So the first thing I want to mention is changing the quality of the YouTube feed. Now, there are some slides here with some small little details, some graphs, some charts that you may want to see a little bit closer. And sometimes in a live feed, you have to keep in mind it takes a lot of bandwidth. So watch that quality. Sometimes people need to turn it up or down. And I always want to remind people that you can always come back and rewatch this later. So you can see it's being recorded in HD. So if you needed to rewind something to check it out again later on, you can always do that. But check that at the bottom right of your YouTube. You'll see the little gear. On mobile, you have to click the three dots near the top, and you can change the quality of the video. The next thing I want to mention is sometimes we have people who have strange issues, buffering issues. Sometimes people say, oh, it's audio issues. But the best thing you can do, the number one way to solve the problem is simply refreshing your screen. So Command-Shift-R, Control-R will help refresh your screen. And that way, usually that'll kind of fix the problem. The last thing I want to mention is the chat box. Love seeing people chat. I love seeing people saying hello. And so on mobile, you'll see it below the video. On the desktop, you'll see it to the right of the video. So in the chat, if you could, again, most of you have done it, introduce yourselves. Don't be afraid to ask some questions too. So if you have some questions, we'll have a little bit of time near the end of the webinar where I'll note them down, or, Kiki's here with me in the room, so she might even just see it. But don't be afraid to ask questions. And as you guys are already doing chat with each other, good students. Good students. They're already doing everything I ask.
There you go.
Fantastic. So really, without further ado, I want to get to the content of the webinar, because we want to make the most of our time and most of Kiki's time here with us. And that's why I want to introduce to you today, Kiki Sauriol-Roode, Vice President of Business Development with Genworth Canada. Now, I think a lot of people from Royal LePage has seen Kiki speak frequently at our events, our leadership conference, our sales conferences. That's where you and I have gotten to know each other. Mm-hmm. So, often speaking at those events, I assume many of you people here today on the webinar have seen her speak. Now, she has over 20 years of experience and proven success in sales and relationship. And that's one of the things that I love about her understanding of what you guys do. I mean, the importance of the relationship in what a real estate agent does is so critical. And I know some of the slides and information she's going to share later on relates to kind of what your clients really want from you as a real estate agent, right? And last thing is Kiki is super active with the Shelter Foundation, with the Royal LePage Shelter Foundation, and in fact is the chair of the board of directors for the Royal LePage Shelter Foundation this year.
Yeah, it happened only a few months ago. I've been on the board for a few years now, and over the last 7 years or so that I've engaged in this wonderful relationship with Royal LePage, it became so evident how important the charity is and the work that it does. So I got involved in the board, and the chair role came available earlier this year. So I'm glad to take even a larger role in helping to move all of that forward.
Congratulations. I didn't know that happened just so recently. Yep. Awesome. Well, let's get started then. I'll kick it over to Kiki for key trends among first-time home buyers.
Mike, thank you very much. And to everybody that's participating, thanks kindly for giving me a little bit of your time. And my hope is that the information that I'm going to share today will really give you insight into what first-time home buyers are thinking, some of the things that are motivating them, some of the challenges that they face, in particular as it relates to some regulatory issues that have impacted the housing market over the last number of years. And we'll close with kind of identifying what some of those regulatory changes have been, how they've impacted the first-time home buyer, and particularly the mortgage insurance market, because I think, as most of you know, Genworth being a mortgage insurer, we're dealing with first-time buyers because it's typically that group that needs to buy with less than a 20% down payment. That's the entirety of our customer base. So we really want to know what they're facing. So, as I say, my hope is that the information that I'll share will give you more insight into what they're thinking, what they're concerned about, so that you can better serve them. And we'll talk, to Mike's point, about some of the content that we've developed that can help you have deeper conversations and stay connected to your customers. And we'll tell you what we're thinking about from a government relations perspective in trying to impact some change to positively affect affordability across the country.
Sweet.
All right. So with that, we'll get right into some of the details of the survey. I'll share some real high-level highlights, but the entirety of the survey can be found on our website at genworth.ca. And we've done this survey now for the last 6 years. We do it every 3 years. So we've got a lot of really great trending data now to really help understand how over the last 6 years, views on the same topics have changed with the first-time home buyer segment. And this time around, we actually engaged Royal LePage directly and had you participate by including 5 new questions in the survey, which I really think just sort of underscores how incredibly collaborative our organizations have become over the last several years. So we're certainly thrilled about that. So you can get all of the details at genworth.ca of the survey. And why don't we just move forward to the next slide? This one, it's the boring one. It just sort of talks about how we actually did the survey, which, we hope just gives you some comfort that it's been done with statistical significance in mind, so the data is reliable. We talked in the spring of this year, so February and March, to almost 1,900 Canadians right across the country in a variety of regions. And Environics is the company that does this survey for us. And so they've done it, since we began 6 years ago. And so they really are familiar with the content of the questions, but also Environics is very well known across the country for their statistical analysis and delivery. So we feel like we've got a lot of confidence in the data. So let's get right into it. And again, this doesn't represent the entirety of the market. This is really those first-time buyers that we're talking to. And so they're buying homes, and you'll see through some slides that are smaller or lower in value than the average price across all regions. But it's because it's their first, maybe second time purchasing. But since we started in 2015, we've actually, in this age group of 25 to 40-year-olds, seen the percentage of home ownership amongst that group drop. We think it's probably leveled out a little bit because we hope we've seen the end of regulatory change. That we say with our fingers crossed, or regulatory change negatively impacting. We hope there's some positive change to come. But still certainly healthy home ownership rates. But, I think it is reflective of the fact that since 2006, when we've seen the stress test introduced, it really has impacted what folks are able to afford. And it has pushed some people out of the market or waiting to join the market. So they're on the sidelines a little bit. We can go to the next slide now. And the good news is, while some of them have been pushed to the sidelines, this first-time homebuyer group is super confident about their financial fitness. They know that when they can get into home ownership, they're ready for it. This is a self-declared question. We ask them a number of questions about their financial fitness, but compared to if we talk to the general population, the first-time buyer segment absolutely feels like they're ready and have good momentum going forward by way of their financial readiness. The one thing that I think is not unexpected is that those that feel most confident are outside the most unaffordable areas across the country. So GTA and GVA. But even despite that, there are a lot of folks that are feeling like they're managing. Very few that are feeling like they're vulnerable by way of their financial readiness. And then if we look at sort of the trending of this data, again, general population versus the first-time buyer group, they've been feeling like they're in good shape since we started this in 2015. And the gap, by the way, is actually widening. They certainly are a group, and you'll see it shortly, that do a lot of research. And you probably know that dealing with them. They come to you already having done some research on the home buying process or the markets that they want to look in. And so because they're a group that does a lot of research, I think they're feeling more confident than the balance of the population. What we have seen over sort of the last 6 years is that there has been a bit of price compression with this particular group. Certainly mean price around what they're buying has elevated a little bit, but the percentage of down payment has also risen. In part, the first stress test that was introduced, really, you saw the biggest gap between 2015 and 2017. That was when the government only had the stress test placed on insured mortgages. So a lot of what that did is have people that were thinking of put, 10, 15% down, say, I'm going to find a gift so that I can put at least 20% down so I can avoid the stress test. Well, in 2018, that stress test, as you know, was applied to all mortgages, conventional or insured. And so that's why you see the gap for 2019, not quite as large. But what we're seeing is more people are putting bigger down payments. We'll talk about gifts and down payments going forward, but what it's really done is shrink the insured space a little. We're seeing more people trying to get below that 20% down payment threshold. So now in the first-time buyer segment, you can see it used to be around 63% of those got an insured mortgage, and now that's dropped to about 58% of them. This slide, I think, is really important, particularly for real estate agents, because this question asked these folks, what are the most important sources of information when you're looking for a mortgage? So it's not when you're looking for a home, but when you're looking for a mortgage. And you can see that real estate agent is at the high end of those sources that they're viewing as most important. And in fact, over the years, your level of importance is growing with this segment. It used to be that 64% of them thought you were an important source. Now it's up to 69%. And so what that really tells us is that they're looking for you as an agent to be sort of an advisor through the entirety of the home buying process. We certainly would never advocate that you give a lot of mortgage advice, but know enough to have a good conversation so that you can then say you really should talk to a mortgage professional for more detail. That's what folks that are dealing with full service agents are telling us they're expecting. The other thing I think is important in this particular slide is that, we hear this first time buyer group or this millennial segment. They're very focused on doing a lot of web research, social media research, and they are. You can see a lot on the bottom of this particular slide is internet and a variety of other social media kind of platforms. The good news for real estate agents is that the top 4 sources, though, are real live people. It means this group is doing a bunch of research, but they want you to help them break it down. They want the advice component. So I think that means a real healthy long-term position for agents that are delivering good, solid advice.
Yeah, and the ones who, again, like you said, will tell them, hey, here's some information, and this is why you should go talk to somebody about it.
Yeah, yeah. So one of the questions we ask them is sort of what's motivating you to buy, or how much is price really impacting your decision? And most of them, no real surprise, are saying that they really believe that prices are going to be increasing over the next 12 months. And that was a significant driver to try and get them into the market sooner rather than later. Last time we did this survey, when we saw a drop off in home ownership amongst this group, a lot of them told us that they really worried that they missed an opportunity
Mm.
to get into the market because of the pressure to qualify had been raised so much with the stress test. So that hasn't necessarily changed. Folks think prices are going to increase, and so they're looking to try and get in as soon as they can. And I think we all know that price really is the most important reason, but over the years, we have come to see that more and more of them are telling us that seeing their home as an investment is becoming more of a priority for them. And a lot more of them are valuing proximity to transit and to work. And that's not necessarily surprising to us at all. Even today here in the GTA, there was a study that came out that over the last 5 or 6 years, the average commute time has risen by 8%. I was actually surprised. I thought it'd be more than that.
That seems low.
But who knows what the details around that stat were. But essentially what it means is people are looking to try and make decisions around how close can I get to work, or how close can I be to transit to help me get to work if I have to move further outside the city. A lot of what we've found with our book, which again, first time buyer based, if we heat map kind of where we've insured properties 6 years ago versus where we are now, we're very much moving outside the core of urban centers. And that's very much an affordability push, right? People are needing to get into home ownership where they can afford it. And so they're moving more outside the city. The piece about seeing the house as an investment, we saw a lot more people talking about wanting to try and rent out a portion of their property to try and help with their monthly payments of their mortgages. And interestingly, where we asked the investment question, people more likely to see their house as an investment were in the GTA or Greater Ontario. Those that were new to Canada were really looking at the home purchase as an investment. So that'll be something important for you to know if you're dealing with those folks that are newer to Canada. This is, part of what's driving them when they're selecting a property. And interestingly, those who were purchasing new construction were more likely to say that they saw their house as an investment, more so than people who were buying resale properties. So if we spend a bit of time looking at down payments, we've really seen the Bank of Mom and Dad increase over the years. And again, very much driven by house price increases and people needing a bigger down payment to try and get in to home ownership. A lot of what we've seen is that families are wanting to give a down payment to their kids while they're still alive so they can see them enjoy their inheritance as opposed to waiting till the parents pass. So that, I think, is a trend we probably anticipate will continue. And half of those that received a gift said that if they didn't, it would have absolutely delayed them buying a house, or just simply they would have looked for a much lower priced property. And if you think about it, in higher priced communities like Toronto and Vancouver, to try and get 5% down or 10% down to buy in Toronto and Vancouver, unless you're getting a gift, if that's part of what you need, to save another 5% on a $750,000 property could take 2-3 more years. So as a real estate agent, I think it's a good news sign that you're seeing some gifting happen, because it's getting those folks in the market sooner than they might have been able to otherwise. The other thing that some of this down payment scenario talked about, we asked questions around what else do you think could have helped you? And we got a lot of comments back freeform about a return to extended amortizations and allowing first-time buyers to go beyond a 25-year AM. So I'm going to sort of placehold that, because we'll talk a bit more about that when I talk about what we're talking to the government about, because we absolutely see that as an opportunity to impact affordability right across the country. And if you think about it, today you can get an extended amortization to 30 years on a conventional mortgage, but you can't on an insured mortgage. And from my perspective, I'd way rather give someone who's 25, 35, or 40 a 30-year AM than someone who's 60. But we'll talk more about that in a little bit. This speaks again to the gift and combination of gift and savings because they're not paying any rent. So there's a lot of folks that are receiving gifts from family members, whether it's mom and dad or grandparents, etc. But then there's a lot of people that are really seeing assistance with down payments because they're staying at home longer. They're living at home with their parents so they can avoid paying rent and using that as savings vehicle. Or they're staying at home with their parents and they're paying well below sort of market rate, which is another way that they're saving. Or they're living with friends or what have you, which is the lived where they didn't pay rent. Some of what we're seeing is just the gift. Some is mom and dad are giving you a gift and they're letting you stay in the basement to help accelerate your ability to get into properties. So about 10% of the people that we talked to in this survey got both a gift and savings on rent. But a full 30% got neither. And so they're on their own. But don't forget, this is a very confident, financially fit group. So even that 30%, they had other ways that they were saving for their down payment. We got a little more in the weeds about their preference to buy homes that were closer to work, even if it was more expensive. And there was certainly a good segment, absolutely, in the major metropolitan areas, Toronto, Vancouver, Montreal, that said they would prefer a more expensive home if it was closer to work. 48% of the group said, I'd pay more if I could be closer to work. They also, though, compromised on size because a lot of them we're seeing are buying condos in those markets. But there certainly is a big segment who's saying, you know what, I'm comfortable with a commute, so I would rather be further away from work if it means that I can get the kind of property that I can grow a family in, etc. When we asked a little bit more about the commuting time, it was interesting. We saw a little bit of self-interest creeping in because a lot of people said, I want to live way closer to work. And if it means my spouse has to commute a little further, well, I'm okay with that. A good number of them wanted sort of a similar commute time for both parties in the house, but certainly some of them thought, no, I'm okay if I can be closer to work if my spouse has to travel a little bit further. But this commute scenario is absolutely playing in more conversations now than it has before. So this comes back to that notion of, so what are they buying? And we're really seeing a growth in the share of condominiums. You know, even though we're dealing with first-time buyers, the majority of our book is in detached properties. But I can tell you that in the last 6 to 10 years, we have been seeing a growing shift to condominium. And that absolutely is driven by two factors. One, wanting to be closer to work, but more importantly, needing to find a property that they can afford to buy. So we see fully detached now at about 50% of what this first-time buyer group is buying. And then condos are next. Lots of townhomes and semis, though, that we're seeing as well. And we expect those three categories versus detached is where we're going to continue to see more upswing. This slide is about who's getting pre-approved before they shop. And this, I think, is a really important slide for you. I don't have the trending slide here, but when we did this in 2015, there were a lot of people getting pre-approved before they went shopping for a house. And it actually dropped in 2017, which we were really surprised at because it was the end of 2016 that the stress test was introduced. And the stress test meant that essentially you had to qualify 2 points above what you were going to pay your mortgage interest rate at. And so negatively impacted what you could afford by close to 20%. So we thought, how are people not getting pre-approved? And it's not a good, efficient use of your time if you're showing people houses and you don't know exactly what they can afford. The good news is in 2019, it rebounded, and we're starting to see more get pre-approved before they start shopping. There's a full 27%, though, that find a house and then they get pre-approved. I think in everyone's best interest, if we can move that 27% and the 13% into that, get them pre-approved before they start to go shopping. I'm sure all of you have mortgage professionals in your markets that, if your customer doesn't have someone they're working with, you can refer them to. Really important to get folks pre-approved so that they know what they can afford to buy and so that you know what you should be showing them. Good news is the trend has positively turned. And then the last slide that I wanted to talk about before we talk a little bit about the change we've seen across the industry by way of regulation is really about this question around putting less than a 20% down payment if there was longer amortizations available. It's about a 50-50 split. We saw a lot of people saying, yeah, I would absolutely do a 30-year amortization if it was available, so that I could still put less than 20% down and then use some of my other funds for other things that I want to do in my life. And so that, I think, kind of feeds a little bit into some of our government relations discussion. But one of the interesting key differences between who said they would use 30-year AM and those that said they wouldn't, we asked a political leaning question, which is, if the election was today, who would you likely vote for? And conservative intenders were more likely to say that they would consider a longer amortization than Liberals, just by a small amount, and NDP intenders even less so than that. But it feeds a lot of the narrative that politicians need to think about today when they're trying to address this millennial first-time homebuyer group. And I've got a couple slides that kind of speak to that coming now. So this slide kind of lines up a decade of change. I have been with Genworth for about 17 years, and for the first 7 years, we didn't see a lot of government intervention in regulating mortgage delivery. The global financial crisis happened in 2007 and 8, and this is kind of really when we started to see a lot of change occur, particularly later in 2008. Canada was then, and still really is, revered globally as having the soundest mortgage financial system. And I think by way of comparison, we're probably more conservative than most countries across the world anyway, which I think is why we came through the global financial crisis as well as we did. But to further shore up mortgage lending, there have been a lot of changes that have happened. We have seen mortgage insurance usage drop from about 40% of every mortgage that was delivered in 2008 to now about 17% of the market. And part of that is because some of the changes just simply eliminated products we were able to insure. One of the changes was no more refinances above 20% loan to value of your home price. All of a sudden, that was business we could no longer insure. We used to be able to insure investment property products. That was changed as well. You now need 20% if you're buying a fully focused investment property product. Extended amortizations have changed over that period of time, but the biggest changes have been October 2016 and then January of last year, when the stress test and the increase in what you need to qualify at by way of interest rate have been introduced. Typically, in a lot of the prior changes, we see about 6 to 12 months before consumers sort of ingest the change and behavior returns to normal. The stress tests have seen a little bit more time for consumers to to absorb it, understand it, and ready themselves to re-enter the market, which in part is why we see a fall in some of the insured mortgage usage amount. What it's meant is that although we've got a smaller mortgage insurance size, it's the highest quality portfolio we've ever seen, really, at an average credit score of about 748. We've been asked as a business to hold a lot more capital than we ever have before in case any crisis occurs again. So we've really shored up the strength even more of the market. But a lot of what this has done by way of consumer behavior is it's driven people away from getting mortgages at branches and more to specialists and mortgage brokers. So again, not dissimilar to them wanting the advice of a full service agent, they're wanting the advice of a specialist to try and make clear what all of these changes actually mean. So we're starting to see a movement away from retail branch originated mortgages in this first time buyer space and more to specialists and mortgage sales forces and brokers. The next couple of slides we take from CREA. They had advocates go out and talk about the impact policy changes have made on the ability to purchase a home to the millennial segment. So again, talking about the same sort of age range. And a lot of what they've said is increasing interest rates has had an impact on their ability to buy. The limit borrowing amount is really significant there as well. And that really is the stress test. Also, the fact that you can't insure over $1 million now is showing up as a portion of what is negatively impacting ability to buy a home. That's really only an issue in the Toronto and Vancouver markets, and is more at the high end of what first-time buyers are able to afford anyway. But the two big things are interest rates and stress test. When we asked what the federal government, and not we, it was CREA, when they asked what the federal government should prioritize, housing affordability ranked number one by way of voter intention. And so I think the good news is that means that you'll see all parties leading up to the fall election have housing affordability as part of their platform. That's only going to be a positive thing for strengthening the housing market and making housing more accessible to more borrowers that qualify, of course, because we certainly would never advocate home ownership for folks that were struggling to afford it. But we've already seen through our earlier slides, a lot of these folks are very well positioned financially. It's just, can they afford the big ticket? The other interesting thing, and Mike, I might have you go back to that slide. The Liberal government knows that it was really the millennial block of voters that pushed them over the edge to give them majority the last election around. So I think they know if they want security again going forward, they need to address this group's number one issue in particular. So we'll talk soon about something that they've done already to address housing affordability. We think much more is needed, but we'll see what the next few months play out. So when we talk to the government, we talk about three key things. Supply, we see that as a more long-term solution because you've got to get federal, municipal, and provincial governments involved. But we see some momentum now with governments talking to one another about how they can positively address the supply issue long-term, because our population of potential homebuyers continues to grow, particularly with our immigration strategy. So ultimately, we're going to need more houses to live in. The other things we're talking about right now, though, to address housing affordability with the government is a movement on the stress test. We know that advocating elimination of the stress test isn't going to be something that the government has an appetite for. But given we've seen some interest rate rises since the stress test was introduced, we really believe that a shifting down slightly is something that would absolutely ease affordability while still keeping some conservatism into the way that we're qualifying customers. We haven't seen a lot of uptake on this from the Liberal government, but certainly when we talk to Conservative and NDP folks, there's a lot more interest in this way to address affordability, because we think that would address affordability right across the country. The other thing that would impact affordability across the country is a reintroduction of a 30-year amortization. And I chatted briefly about that earlier in the presentation, but today so if we remember that insured mortgages is only 17% of every mortgage originated, that means that 83% of mortgages that are done today, you can already get a 30-year AM on those. And if we look at the first-time buyer segment, if the stress test is still in place, and so we're still adding in a buffer to ensure they've got room should interest rates rise, adding 30-year amortization, we advocate we would rather give it to someone who was earlier in their income growth potential stage, earlier in their career, than someone who was much later in life taking on 30-year amortization. And if we look at the way that a 30-year AM performed in our book when it was available before 2008-9, it performed extremely well. So we really think there's a lot of data to suggest that it is a really valuable option to consider to address affordability right across the country. If we go to the next slide, this is a summary of what the Liberal government introduced in their budget in March to try and address housing affordability. It doesn't include change to stress test. It doesn't include 30-year amortization, but you've all probably heard about it. And it is this notion of a shared equity mortgage where the government will give you on a resale property, if you qualify under their parameters, 5% of your down payment, or if you're buying new construction, 10% of the down payment. That certainly is an appealing option. A lot of what we've done by way of calculation is that it wouldn't help a lot of borrowers because based on the criteria, they could likely already qualify today on their own without the need to share equity with the government. It certainly would impact some people, though, positively. The other thing that's important to note is that to qualify, you cannot buy a home that is greater than 4 times your household income. And the household income max is $120,000 a year, which means that you can't buy a property more than about $480,000. So that's certainly not going to help anybody in Toronto. It's not going to help anybody in Greater Vancouver area, which is why we think this is an option to address affordability, but it's not addressing affordability for those folks where we're really seeing the majority of homeownership occurring. Which is why if we look at an amendment to the stress test or introduction of 30-year amortization, that allows easement from an affordability perspective for everybody, irrespective of what region of the country you're buying in. The other thing I'll say about it is that it's too soon to assess what the impact is going to be, in part because we still don't have any details about this program. Good news is that they're taking our feedback. They're taking the feedback of lenders, but it's meant to launch on September 2nd, and we don't have enough detail yet really to develop our systems to deliver this program. So there'll be a lot of work done over the next couple of months to try and make sure that it's ready to go. But the other thing that they announced in the budget, which we do think certainly will help some folks, is increasing the ability to leverage RRSPs from $25,000 to $35,000. I'd say that it's positive because some folks can do that, but a lot of what we hear from our lender partners is that a lot of first-time buyers don't have $25,000 saved in RRSPs. So an increase to 35 won't really help them. A lot of them have more saved, but it's in a TFSA or it's in another vehicle. Where this will help, though, is that they have allowed now this to be utilized for in a separation scenario where it wasn't able to be before. So it really will help people who are needing to leverage RSPs if they're separating or divorcing. So that's positive. That kind of brings me to the end of most of what I wanted to chat about, other than to just share a little bit with you about the kind of content that we develop, not just this survey that I've talked about, but a bunch of other pieces that we really hope you leverage when you're talking to your customers, whether it's in-person conversations or sharing articles that we develop on our website, in some of your communication strategies. We've got lots of videos, articles. We've just this year created a 30-plus page first-time homebuyer guide that you're able to digitally share with your customers. Lots of ways that if you leverage it well, you can drip content to your customers every couple of weeks to make sure that through that buying process, you've got ways to stay in touch with them. So have a look, either genworth.ca or homeownership.ca, and really take advantage of that content. We don't have a direct-to-consumer strategy, so we're not pushing this to consumers. It's really there so that partners like yourselves can leverage it in your communication strategies.
And I think that actually answers one of the questions we just got. And I don't know, I'm a little far away from the mic, but I'll try to speak up. From Jody Canning, she said, any idea when Genworth will be sharing this information on social media? Now, Jody's from Royal LePage Pro Alliance in Cobourg. So if I'm gleaning what you're saying is you're saying, hey, look, we're giving you the tools. We're giving you the stuff. Agents are always saying, what should I share on social media?
Yep.
And you're literally saying, here's a whole whack of stuff you can share on social
media. So this is website-based stuff that I'm telling you about now, but we're also on Twitter. You can find us on Facebook, I think genworthsmartshopper.ca, and we're constantly putting, I think probably at least every couple of weeks, you'll see something new on that Facebook page that you're able to leverage and share. So there's lots of places you can find us and leverage that content. Talked about this large first-time homebuyer guide. It's new this year, and again, it's available on our website that you're able to share the digital link with your customers. And it's 30 pages of all kinds of things that a first-time homebuyer might need to consider when they're buying a property for the first time.
Well, this is also great, again, when you're signing people into an open house and, you're saying, well, they give me fake email addresses. So this can be a really great tool for that. When you say, hey, when you sign in, hey, I have this great first-time homebuyer guide. Would that be something that you value? I'll send that off to you today or immediately, right? Or while you're sitting in the open house.
That's amazing.
Hey, that's what I do.
Who gives a fake email address?
I have fake email addresses. I have layers.
I got you.
Layers, like an onion.
Yeah, I got you. That's what I had for you today. So don't forget, if you want more details about the survey, even than we went through today, go to genworth.ca and you'll be able to find the first-time homebuyer survey.
So I have a couple questions that came in that I want to talk about. One of them came in from is saying, like, just how was the response across Canada to the initial survey? And I think you covered a little bit about that, but I was looking at it going, it's coming from Alan Morrison, who's with Royal LePage Premier in St. Albert. Mm-hmm. And he's kind of just saying it was one side of the country more represented than another. Is there more in certain provinces? How are they ensuring this is statistically representative, right?
So kind of based on, and listen, I'm going to try and answer your question, but from a methodology perspective, Environics was really able to pull numbers together based on population representation. So there would have been more people questioned in Ontario than Atlantic, as an example, but it would be a direct sort of statistically significant or regionally represented percentage that you'd normally see across the country.
Yeah, and you touched upon it was Environics who did the actual.
Environics did it on our behalf.
And our agents should be familiar with Environics. Environics also provided the data for our Your Perfect Home campaign on royallepage.ca, the one that we won 2 Canadian Marketing Association awards for. Most agents have no idea that we did that.
Yep.
But So they're in the business of data and appropriate representation.
Yeah.
Yeah, thanks for the question, Alan. I really appreciate it. Now, I have another question that came in here. It says, I read in an article something about 10% incentive that will be provided by federal government to first-time home buyers. Now, that's coming from Nav Gill.
Mm-hmm.
And
Nav, that's a little bit of what I talked about on the shared equity mortgage slide. So it's back up now. And essentially, it's a program that was announced by the federal government as part of their March budget. The intention is for it to launch on September 2nd. And what they're saying is that this program has $1.25 billion worth of money available over the next 3 years that home buyers who qualify could go to the government to get a portion of their down payment. 5% down payment is available to people buying a resale property. Up to 10% is available if you're buying a new construction property. I don't have a lot more detail to tell you than that because, as I noted, we're still waiting for a lot of details from the government so that we can really deliver this program effectively. Banks similarly are waiting for the details so that they can adjust their systems to deliver a mortgage where part of the down payment comes from the customer, part comes from the government. There's lots of questions about what happens when the customer wants to pay it back. What happens if I renovate my house and my equity goes up? Do I share in that with the government? What happens if house prices depreciate? What happens if I want to switch my mortgage from one lender to another? So there's still a lot of details being worked out. But launch date is anticipated for September 2nd. So no buyers can take advantage of it before that.
Gotcha. If it goes up, no, they don't get any share. If it goes down, then they take all the share of whatever went down. That's the way it works, right? No?
Mike is speaking on behalf of the government.
You can watch for me on the ballots.
We'll see.
It's coming up.
Yeah.
I have a question just in terms of, it's good that we're on this slide, but in terms of clarifying that question about that RSP to purchase a home in a divorce. So it said, I heard that if a couple is divorcing, the wife or husband can use the RSPs to purchase a home. Did I get this right? And that's from Auntie Winnie, who I'm look up where she is. But sorry. And I wanted to respond to one question about that. Somebody asked about social media and where to find it. Just go to genworth.ca, and the bottom right of the page, you'll see their links to Facebook, LinkedIn, Twitter, and then you can find them there. So before you get to that question, just on reiterating this question about that RRSP split.
Yeah, so it is right, which is great because typically people, so my earlier comment was a lot of first-time buyers who are able to take advantage of it today might not have 25 or 35% thousand saved in their RSP, but as you're married and building your financial net worth, etc., people often do save in an RSP. So should a marriage collapse, they probably do have more in an RSP than a first-time buyer would. So the ability now to leverage sort of a buyout or whatever in a divorce situation from your RSP is a positive change.
Yeah, and a strategic partnership between a husband and wife might recognize that we don't need paperwork, we can, and then we can make benefit of it. I'm going to go home and discuss this with my wife.
Wow, Mike has really got a lot of.
I got to scam my way to the top.
He's got to scam a lot of different things. You can probably, though, to be totally fair, there's likely more details on that you'd be able to find with the government's budget announcement from March.
Well, and I think it's just good that the people here in the webinar know about it, go out and seek it, go find it, and get more information again, because as Kiki shared with us, your clients are one of the biggest things that you've mentioned every time we look at these studies is that fact of, your clients are going to you and they want your advice on this. So you have to be knowledgeable about it. Again, knowledgeable enough to help them and knowledgeable enough to tell them when they need to move on and find somebody even more specialized, right?
Exactly. And the other thing, always leverage your mortgage professional partners. So whether it's a bank specialist or whether it's a mortgage broker, they'll be acutely aware of some of these changes as well and be able to have good, meaningful conversations both with you as well with your customers.
Yeah. Well, let me see. I mean, we'll give it a little bit more to see if there's any other questions. Again, I'll encourage you, go to genworth.ca, go check that content out, pull up their social feeds, go follow them. You'll have great content to share. And again, if you haven't checked out the study, as mentioned, it was done in cooperation with Royal LePage. So it's really fun to work with that and to have that. You can find that as well on genworth.ca.
Absolutely.
And get the full study so you can really understand all the information that's in there. I wanted to ask, I mean, if you were to kind of, because we being on the road a lot, I get a lot of questions around millennials and working with them, and I see a lot of articles on crazy amounts of debt, and I remember reading one that said we're expecting more defaults than ever in the next 10 years. How would you kind of typify this first-time buyer generation? I mean, because I'll be honest, a lot of the stuff you're saying here, you're saying they seem pretty financially, they feel good.
Mm-hmm.
And when I see posts of, I barely afford my avocado toast, right? It always makes me question. So, like, in what you've seen in the raw data and everything, what is your sense about this first-time buyer group?
So I think a few things. First of all, they're self-declaring that they're financially fit and well prepared. I think the sense of importance of home ownership still resonates really, really strongly with this group. And while they might take on more debt, we're not anticipating significant increases in defaults. Most Canadians will give up a ton of stuff before they'll default on their mortgage. So have discipline enough that where they need to adjust monthly behavior, they will. We're actually anticipating a bit of an increase in defaults and in our loss ratio, not because we expect that more will default, but there was an oddity that occurred over the last couple of years, in that when we saw such accelerated house price appreciation in Vancouver and in Toronto, where we see a lot of our insured portfolio exist, if someone lost their job and defaulted on their property, it didn't actually come to us as a loss, because if they defaulted on their property that they bought 3 years ago, well, now it's worth $180,000 more. So they just sold their house, paid off their mortgage, and moved on. So we saw unusually low loss ratios. So we anticipate a bit of a rise, but just a rise back to normal. The other thing I could say about the first-time buyer population is that we really measure affordability based on GDS and TDS, gross debt servicing and total debt servicing. So what they can afford based on what the mortgage is and what their income is. And then the second one adds in what all their other expenses are. And we haven't seen a massive increase in those ratios over time, which tells us that people are getting into home ownership really well prepared. And I shared a slide that our portfolio is as healthy as it's ever been by way of strong credit score, et cetera. So the people that are entering into home ownership are well prepared.
Interesting.
Yeah.
Interesting. Thank you for that.
You're welcome. Now, are they taking on more debt after they buy their house and they're buying like a second fancy car and something? They may very well be, but we're not seeing and not anticipating them to default. We're seeing them either financially be able to pay for that, or they're getting rid of it before they ever have to think about losing their house.
Gotcha. One thing that I will say in terms of going kind of way back to Alan's question about the regionality of this is if you do go to genworth.ca, you'll see on their studies, they do a lot in terms of the regional side of things. And, Kiki and I have done webinars in the past where we looked at a national view of first-time buyers and compared different regions. And I would say it's really interesting to see and understand the different trends across Canada, right? Not just what's happening locally, but what's going on nationally. So, well, I'm going to look and see. I don't have any more questions.
All right.
I have the opportunity of when the webinar ends, I can keep asking you questions until she tells me to stop. But firstly, I want to thank everybody who tuned into the webinar. I'll encourage you to go to rlp.ca/training. On the top right, you'll see webinars. We got another webinar coming up next week, Thrive in an Evolving Industry. So you can tune into that. You can register for that there. Next, I want to thank you, Kiki, for coming down to 39 Winford, for spending your time with me and spending your time with these fine folks on the webinar.
Very happy to do it anytime.
It's fun.
It was good.
It's always fun.
And I get to see all my friends at head office here. So
Yeah.
glad to come down and hang out for a while.
It's fun. So thank you so much for coming. Thank you for sharing your knowledge. I mean, I'll say, like, I see a lot of agents who are kind of struggling to really understand these people, right? And saying, how can I help them? So this kind of insight is so valuable to them.
Well, that's the goal, right? I want, if I'm going to spend some of your time and take it, I want to make sure that you leave feeling better informed than you did when we started.
Yeah. So thank you. Thank everybody on the webinar, and hopefully we'll see you guys all next week. Have a great day, everybody.
See everyone.